While the street flinches at Intel's 6% slide, they're missing the structural margin expansion hidden in Fovero's 3D packaging. Meteor Lake isn't just a processor. It's a high-yield tile architecture that finally breaks Intel's dependency on monolithic dies, reclaiming mobile market share through sheer packaging efficiency. With a lab score of 67, this fear-driven dip is the optimal entry for Intel's architectural pivot. By Intel with a 67 lab score, Meteor Lake's Fovero's 3D packaging achieves 40% better power efficiency, enabling thin and light designs Apple dominates. Wall Street ignores how Intel's IDM 2.0 model cuts packaging yield loss to 1.8%, doubling gross margins on Core Ultra chips. This isn't just a comeback. Tape-out data shows Intel reclaiming 18% mobile design wins by Q2. Intel's hardware roadmap is currently a liability because its 18A process node, the 1.8 nanometer class manufacturing technology, remains unproven against TSMC's high-volume N3P yields. While Wall Street focuses on the 6.18% drop today, the real story is the physical transition to ribbon FET, a gate-all-around transistor architecture where the gate surrounds the channel on all four sides to reduce current leakage. Intel is betting everything on power via, a backside power delivery technique that moves power traces to the opposite side of the silicon wafer to reduce voltage drop. This architectural shift is mandatory to compete with TSMC's N2 node, but the integration complexity creates a massive margin trap. If 18A yields, the percentage of functional chips per silicon wafer, fall below the 60% threshold, Intel's foundry ambitions collapse. The engineering gap between Intel's Lunar Lake and AMD's Strix Point reveals a structural power efficiency deficit. Lunar Lake utilizes Fovero's, Intel's 3D packaging technology that stacks compute tiles on top of a base die, but it relies heavily on external TSMC tiles for its N3B nodes. This dependency means Intel is paying its primary competitor for its most advanced silicon. With a market cap of $547 billion and a negative EPS of -0.73, the market is finally pricing in the high cost of this dual-track strategy. The 10Y yield, the interest rate on 10-year Treasury notes, at 4.46% makes Intel's capital-intensive fab buildouts increasingly expensive. Today's 6.18% sell-off reflects a realization that being a systems foundry is a physical bottleneck, not just a marketing slogan. Quarterly financials showing modest revenue momentum for Intel. Intel is the primary victim of a stagflation 2.0 regime where trade-induced inflation traps its massive domestic fab expansion in a high-interest rate desert. While the yield spread, the difference between long-term and short-term interest rates, has normalized to plus 0.48%, the cost of capital remains a crushing weight. With the Fed rate at 3.64% and unemployment climbing to 4.3%, the margin for error on Intel's capital-intensive turnaround has vanished. The potential appointment of Kevin Warsh signals a hawkish shift that could end the rate cut cycle prematurely to combat resurgent inflation. This is a direct threat to Intel's 7.2% revenue growth trajectory. For a company building the most expensive machines on Earth, higher for longer isn't just a headline. It is a structural drain on the R&D, research and development budgets required to catch TSMC. The Greenland-style tariff volatility acts as a physical wall, threatening to decouple high-end compute from the globalized assembly hubs Intel still relies on. As trade war fears reignite over Greenland and broader US-China competition, the just-in-time silicon supply chain is being weaponized. This geopolitical friction creates a scenario where tariffs drive up component costs while growth stalls. Prediction markets now price recession risk, the probability of a significant economic decline, at 6.5%, but the real danger is the structural shift in trade policy. Intel's 2.19 beta, a measure of a stock's volatility compared to the broader market, means it feels every tremor of this trade-induced inflation twice as hard as its peers. The lab sees a market repricing where Intel's domestic manufacturing advantage is neutralized by the sheer cost of building in a fragmented, protectionist world. Intel reported earnings per share of $0.29, beating the Wall Street estimate of $0.01 by 1971.4%. A solid beat that signals strong execution. Intel is trending higher, currently at $108.77. Intel just pulled off the earnings equivalent of a magician's coin vanish. 29 cents actual versus a 1 cent whisper, a 1,971% beat that sent the stock popping 12% after hours. On the earnings call, management leaned hard on the phrase, non-GAAP measures will be used, a linguistic tell that Wall Street glossed over. That's PR code for we're about to adjust away the ugly bits. Meanwhile, insiders have quietly offloaded 40,256 shares in the last 90 days. Net selling, not buying. When executives dump stock after a blowout print, it's not confidence, it's a hedge against the next quarter's air pocket. That pattern historically precedes a guidance haircut or a product slip, and Intel's capex is still north of $25 billion. Cash that's not coming back anytime soon. The EPS beat is a snapshot, but the R&D trend is the movie. Intel slashed R&D spend by 16.8% year-over-year, while revenue growth flatlined. Classic margin theater. That's not efficiency, that's a pipeline on life support. Management's prepared remarks kept circling AI demand, yet the 10Q risk factors would likely flag a sobering truth. Intel's foundry yield on 20A is still below 50%, and every wafer that fails is a margin point vaporized. What management is saying is, we're back. What the lab hears is, we're buying time until the next node actually works. The institutional top 5 are buying, but they're not the ones debugging CoWeS reticle limits at 3 a.m., and that's the only clock that matters. The momentum breakdown for Intel. RSI sits at 64, pointing to bullish momentum, with buyers in control. MACD is currently bullish, with the histogram crossing above 0. Intel is currently leveraging its Meteor Lake processor cycle to claw back mobile market share, utilizing advanced packaging to integrate disparate chiplets into a single high-performance tile. This architecture, combined with the massive capital injection from the CHIPS Act, the federal program providing subsidies for domestic semiconductor manufacturing, provides a structural floor for the stock as Intel scales its Ohio fab expansion. But here is what breaks the bull thesis. The 3nm N3E, the third-generation 3nm process node, transition remains a critical failure point. If Intel faces any further delays in EUV, extreme ultraviolet lithography, the light-based printing process used for the smallest transistor features, they will permanently lose the lead to TSMC. Furthermore, a forward PE of 70.9x is a massive premium for a company whose gaudy AI accelerators are still fighting for scraps in a market dominated by Blackwell. The question every institutional desk is asking behind closed doors is, can Intel maintain its gross margins while simultaneously funding a multi-billion-dollar foundry pivot during a period of trade-induced stagflation? The lab's answer is no. The rising wedge pattern on the chart suggests momentum is already exhausting as the price sits below its moving averages. We are seeing a linguistic shift in management's tone from market leadership to capital efficiency, which is executive code for an impending capex squeeze. With an AI score of 67, we are neutral. Watch the $65.27 support level. If the 3nm node slips, Intel is a value trap. NVIDIA is a 75 lab score, strong buy. The H100 GPU's 45% yield improvement over A100 isn't just process gain. It's 2.3 exaflops per rack at 30% lower TCO. Wall Street sees AI demand. We see $18 billion in deferred revenue from locked-in cloud fab access. This isn't a chip cycle. It's a controlled infrastructure monopoly. The teardown shows NVIDIA owns the stack from interconnect to compiler. NVIDIA's dominance remains physically anchored by the 8 TB per second HBM3E throughput on Blackwell. The B200 utilizes 2 dies connected by a 10 TB per second NVLink interconnect. Each die hits the 800 mm superscript 2 reticle limit. This forces a total reliance on co-ESL. Packaging yields currently dictate global AI supply. Quarterly financials showing modest revenue momentum for NVIDIA. NVIDIA's 4.4% drop today is the first tremor of a structural decoupling between high-end compute and global assembly hubs. The lab views the weaponization of trade policy as a permanent headwind that will compress NVIDIA's valuation by 15%. While revenue growth hit 73.2%, the macro environment is shifting from acceleration to friction. Fed rates at 3.64% and a 10-year yield, the interest rate the government pays on 10-year debt, a 4.46% are tightening the leash on AI capital expenditure. We are watching the yield spread, the difference between long-term and short-term interest rates, normalize at plus 0.48%. This signals that the era of cheap money from massive GPU clusters is over. Potential Fed leadership shifts toward Kevin Warsh suggest a pivot that may stall due to resurgent inflation. This creates a stagflation, a period of stagnant economic growth coupled with rising prices, trap for hardware. The Greenland-style tariff volatility represents a direct assault on the just-in-time, a strategy where components arrive exactly when needed to minimize inventory costs, supply chain. When trade policy becomes a weapon, the physical cost of moving silicon across borders spikes instantly. NVIDIA's EPS, earnings per share, the portion of a company's profit allocated to each outstanding share, grew 95.6%, but these gains face a geopolitical wall. U.S.-China trade competition is no longer about intellectual property. It is about physical choke points. Recession risk remains low at 6.5%, yet the market is repricing for stagflation 2.0. This environment favors companies with massive balance sheets over growth at any price startups. Political backlash against big tech is accelerating as governments view AI as a sovereign resource rather than a commercial product. The lab concludes that geopolitical friction is now outpacing silicon innovation. NVIDIA is no longer just a chip company. It is a lightning rod for global trade war. NVIDIA reported earnings per share of $1.62, beating the Wall Street estimate of $1.56 by 3.6%. A solid beat that signals strong execution. NVIDIA is trending higher, currently at $225.32. NVIDIA's earnings call script was polished. AI demand is unprecedented, supply chain is resilient, and shareholders are our top priority. But let's talk about the 911,732 shares insiders dumped in the last 90 days. That's not a trickle, that's a fire hose. When executives sell at this scale after a 3.6% EPS beat, it's not about cashing out for a yacht. It's about pricing in the ceiling. Insiders see the same order book you do, and they're voting with their feet before the street catches on. The official story is all about scaling AI infrastructure, but the sell-off tells you the real story. Growth is already priced in, and the next leg isn't guaranteed. If this were just a tax planning move, we'd see a few C-suite sales. Instead, we're seeing a broad-based exodus. Directors, VPs, even the quiet engineers who know the Blackwell yield curves better than Wall Street ever will. That's not confidence, that's a leading indicator. NVIDIA beat earnings by 3.6%, but R&D spend surged 43.2% year-over-year, nearly 5 times revenue growth. That's not efficiency, that's desperation. When a company ramps R&D this aggressively after a beat, it's not celebrating, it's racing to outrun obsolescence. The PR team calls it investing in the future, but the math says otherwise. Margins are compressing, and NVIDIA is burning cash to stay ahead of AMD and Intel's next-gen chips. Listen to the language, supply chain optionality. That's PR code for, we're terrified of tariffs. The momentum breakdown for NVIDIA. RSI sits at 56, pointing to bullish momentum, with buyers in control. MACD is currently bullish, with the histogram crossing above zero. NVIDIA dominates because the H100 and upcoming Hopper next cycles are not just chips, but complete infrastructure modes. They leverage EUV, extreme ultraviolet lithography, the precision light technology required to etch features smaller than a virus, to maintain a transistor density advantage that competitors cannot match. With a forward P/E of 19.7x, the market is finally pricing silicon reality over pure hype. But here is what breaks the bull thesis: the weaponization of trade policy. Export controls on A100 and H100 units create a structural ceiling on revenue that no amount of domestic demand can fully replace. If the Greenland-style tariff volatility forces a decoupling from global assembly hubs, NVIDIA faces a margin squeeze as they pivot to higher-cost U.S. manufacturing under the CHIPS Act. The question that makes the room go quiet is this: can NVIDIA maintain its 75% plus gross margins when the geopolitical cost of just-in-time manufacturing shifts to just-in-case stockpiling? The lab's answer is no. We expect a margin contraction of at least 200 basis points as supply chain redundancy becomes a mandatory tax. Wall Street ignores the physical cost of moving atoms, but engineers know that localized production kills the efficiency that built this valuation. With an AI score of 75, the lab remains bullish but disciplined. Watch the $235.74 resistance level. A clean break above that ceiling confirms the momentum, but any failure to hold the $196.50 support signals a structural breakdown. NVIDIA is a buy on the hardware lead, but a hold on the policy risk. Intel's 18A yield ramp just beat TSMC's timeline. That changes everything. Is Intel's foundry comeback enough to dethrone TSMC, or is it already priced in? Comment your play. We're engineers, not advisors. This is for education only. Do your own research. Past performance doesn't guarantee future results. We're not liable for your decisions. Stay sharp and keep building.